Hello, welcome to Monarch Private Capital's Tax Incentives webinar on Opportunity Zone Investments. Since the U.S. Treasury has issued its second set of proposed regulations related to new Opportunity Zone tax incentives, there has been a significant increase in the level of interest and the pace of questions on investing in Opportunity Zone funds. In today's webinar, Billy Uji will share his insights and information that he's gathered on Opportunity Zone investments, specific opportunities, what to look for in a fund and the fund managers, and why now is the time to seriously consider. Billy is particularly qualified to lead this because of his experience in managing alternative strategies and his involvement in setting up OZ funds. Before we dive into the presentation, I'd like to remind you that this presentation is for informational purposes only and not intended to provide you with investment advice. So now I'd like to introduce you to Billy, and Billy, please take it from here.
Thank you, Jane. Good afternoon. Many thanks for giving us some of your time today. Before we discuss Opportunity Zones, please allow me to give you a little bit of background on Monarch Private Capital so you understand our perspective and strategy as we approach this subject matter. Monarch Private Capital is a 15-year-old nationally recognized tax-advantaged investment firm that has a focus on affordable housing, historic rehabilitation, film production, and renewable energy. We have projects all over the country, and we've closed over 100 funds and 500 projects within 25 states since 2005. We've created over 20,000 affordable housing units. Today we have over 225 assets being managed nationwide by our group with a value in excess of $500 million. We've invested over $150 million in 50-plus historic rehabilitation projects over some 15 states. When this program was introduced a couple of years ago, and we took a closer look at the designated areas once they were finalized last year, we realized we'd actually been investing in Opportunity Zones now for over 13 years. We realized that we had successfully backed many developers in economically challenged areas that were building affordable housing projects that needed to be rehabilitated, like mills. We've been putting solar farms in areas that were deemed to be in Opportunity Zones. We have 30 of those at this point in time. And what's ended up happening, we built up a tremendous pipeline of deal flow because we've had so many successful partnerships with developers that are internally financed or externally financed that have been operating in these newly designated Opportunity Zone areas. So now let's ask the question, what are Opportunity Zones? They're low-income census tracts that have been designated by the governor's office of every state and the federal government. And they were put inside of the Tax Cuts and Jobs Act of 2017 in order to attract tax-advantaged investments to promote economic development in those areas. Simply put, these are private-public partnerships of which we've been engaged in for years. They're designed to really spur economic development and job creation by enticing investors to invest in real estate and enterprises in these designated distressed communities. As you'll see on the map on the right, there are many of these areas throughout the country. By number, there are over 8,700 of them in all 50 states and Puerto Rico. If you click on the link at the bottom of the map picture, you might find it interesting because you can drill down into any of the communities that you might be interested in. 75% of the Opportunity Zones end up being in metropolitan areas. As Jane said, there's a lot of excitement that has come about in the recent weeks. And why is that? Well, it really has to do with the new set of rules and regs that have come out, or much less the clarifications, as it relates to this program. This is one of the most innovative and attractive programs that we have ever seen come out of the government, and it happens to be the federal government, instead of just at the state level. It is trickling down to the states. It's promoting the deferral, reduction, and elimination of capital gains taxes. on gains that come from any type of asset sale. It allows U.S. tax-paying individuals and entities to be able to liquefy their gains and reallocate those gains without the principal into any new investment they can find in these qualified areas. Unlike a 1031 that many real estate investors know about, where they have to roll over all of the investment, one investment after another, in order to protect it from the tax. Real estate investors today are actually calling this the 1031 unlock. For those that are taking advantage of this program, they're able to realize lower taxes on their realized gains. They're able to essentially get an interest-free loan from the government to reinvest the gain money that's not being taxed and the money that they're not having to give to the government for the tax into a new investment. They're able to get diversified investments in their portfolio by being able to strip the gain off from the principal. They're able to do many things that they wouldn't be able to do if they had to roll over a 1031 or if they didn't have the ability to sell the asset tax-free. Keep in mind, the gain that you reinvest in a qualified opportunity zone and held for the compliant time period allows you to compound your gain tax-free, which allows you to make a lot more money. As of 6 weeks ago, Treasury really gave us what we consider to be ample guidance for us and all of our investors to make 2019 real estate investments. Not only do we feel comfortable making them at the federal level, but we're now seeing that there are many states that are going to give us overlay programs to give us state benefits to marry up with the federal benefits. So what are the tax benefits? Let's focus on the federal benefits. The program allows us to defer the tax on the gain that we've just recently realized, and we can defer that tax if the investment is made into a qualified opportunity zone fund and held for at least 5 years. We defer that tax until roughly the 12/31/26 period, which means you don't have to pay it until April of 2027. If you hold the investment for 5 years to 7 years, the tax is reduced by 10%, which means you need to be invested by 12/31/21. If you want to get the 7-year benefit, which is to reduce the tax by 15% on the deferred gain, you must be invested by 12/31/19. And keep in mind, regardless of whether it's the 5-year or the 7-year program, you need to hold the investment for at least 10 years, and the gain on the investment that you have held for at least 10 years will be tax-free. So let's take a look at how this looks numerically. I've tried to give you an example of a traditional investment and a qualified opportunity zone fund investment with $1.5 million capital gain. On the right side of the page, I've essentially shown it in 6 different steps. Number 1, the gain separated from the principal, $1.5 million invested in the traditional investment. Let's go down to number 2. The taxes need to be paid, but only on the traditional investment. This could be paid at a 23.8% rate. $357,000 is due. So the investor with the traditional investment is only going to have $1,143,000 to reinvest. For those that have gone into a qualified opportunity zone fund, their tax is going to be reduced by 10%, so it's going to go from $357,000 to $303,450. But they don't have to pay it until the end of the 2026 provision year, which will push them out into 2027. The thing that is important to note is they still have the $1.5 million to invest today in the new investment. That's a 31% benefit over the $1,143,000. So let's assume that we've invested those 2 different amounts, the $1,143,000 and the $1,500,000, in an investment that yields 9% per annum. After 10 years, the $1.1 million becomes 2.7. The 1.5 becomes 3.5. That's a 23% improvement over the 2.7. Just less than $1 million gain. Now, if you go down to number 5, the tax man's going to come calling. He's going to want you to pay the $303,000 that you owed him for the reduced tax on the $1.5 million gain, but you're now paying it 7 years later. And you're going to get a 15% savings, and you will have been able to invest that money for that 7-year period to realize a gain on it. So what's the net of everything? The net is, on a traditional investment, you're going to make $1,190,000 versus $1,147,047, which is a 46% benefit in going into an opportunity zone investment. Now you're asking the question, how do I go into these investments? Well, let's look at this diagram and take it left to right. An investor is going to sell the asset. They're going to strip the principal off, put it back in their pocket. They're going to take the gain. They're going to identify a qualified opportunity zone manager. They're going to put it in their qualified opportunity zone fund within 180 days. That manager is going to then need to invest into a qualified opportunity zone property within another 180 days. And that property is going to need to be put in service and completed within a 30-month period. It is vitally important that you pick a qualified, reputable manager for this fund, because compliance is something you can't mess up. And if you take a look at the list that I have put on this page, they need to be able to adhere to the semi-annual test of 90% of the assets being in qualified opportunity zone properties. No more than 5% of those assets being in non-qualified properties, stocks, bonds, liquid assets, etc. Within the portfolio, there can be no sin businesses, no golf courses, country clubs, racetracks, massage parlors, places that Bob Kraft would visit, alcohol distribution, or the like. And very important to note that the asset that is purchased and put into the fund and then is improved to be put in service has to be substantially improved within the 30-month period, which means the property basis must be increased by an amount equal to the original cost of the property. So once you've identified your fund manager and you go to invest with them, you're probably going to see a couple of options. They're going to offer you either a single asset fund or a multi-asset fund. And let's just touch on the differences. And I'll start on the right side and go to the left. The multi-asset funds essentially are blind pool of assets that are commingled from a wide variety of number of investors. The manager has discretion over all of the assets. They're going to manage the diversification of the pool of assets by type, geographic location, the sizes, and they're potentially going to be limited as to what assets they can go into if they have a large amount of money. Large funds typically go to large assets. Small funds go to small assets. On the other side of the coin, you're going to see single asset funds. Single asset funds are almost 180 degrees from the multi-asset fund. It allows the investor to be able to manage the diversification for themselves. It allows them to be able to opt in and opt out of investments that they desire. They can terminate their investment when they see fit. If they didn't want to stay the 10-year period, they could break it if they work with the fund manager. At the same time, they're not going to find themselves subject to possibly being held back on their redemption of assets after an asset has been sold. So the flexibility is greater with single asset funds. As it relates to the target investments that would go into these funds, we look at some being aggressive and some being conservative. There are speculative commercial real estate developments that are done that involve industrial, office, core market projects and retail, land speculation, and at the same time, they're what we consider to be more conservative investments where workforce housing is being put up to satisfy what is a shortage of housing for those who are in need. Student housing, renewable energy projects, solar farms, senior housing, and hospitality when it's in communities that we have been exposed to through historic rehabilitation. The investment process, regardless of whether you pick any of the aggressive or conservative or any one type over the other, typically is the same. The manager is going to work with all the various parties they know within the industry to help them source opportunities, whether it be the bankers, the real estate agents, the advisors, developers. They're then going to source those projects. They're going to evaluate them. They're going to underwrite them, put them through their due diligence. If they decide to move forward with some type of an investment, they're going to take them to a letter of intent, put it under contract, buy it, make the investment. Then they're going to build it out, improve it, do the substantial improvement, and then they're going to have to monitor it. They're going to monitor it to the standards that they have for their own real estate developments, and they're going to have to monitor it to the standards that they have to pass for the Opportunity Zone investments. Now that I've walked you through the basics of the Opportunity Zone program and how to invest in it, let me touch a little bit on what we're doing. We use single asset vehicles because of the simplicity, the flexibility, and the ability to be strategic. It allows us to have transparent assets for ourselves and for our investors versus being in a blind pool. It lets our investors underwrite those assets themselves versus just relying on us to determine the asset and the value of the asset. In addition, it allows them to be able to opt in or opt out of these assets and build their own portfolio as they see fit. They can manage their own diversification. And when they create future gains, they can allocate those gains to us as they see fit. When they terminate Qualified Opportunity Zone program for their own use of assets, it allows them to stop investing. And when they want to get their money back, their cash redemptions are not going to be subject to the provisions of a multi-asset fund. As it relates to our targets, as I alluded to earlier, we focus on things, one, that we know, we've been in for a long time: multifamily workforce housing, student housing, renewable energy, senior housing, hospitality. All of these areas we know. We've been investing in them for years. Now, the demand characteristics we find to be very compelling in workforce housing, student housing, senior housing. The housing inventory plays into their favor. Expensive housing plays into their favor. Each of these investments we consider to be very conservative. If you look into these designated areas as they are now, there are 35 million people, 24 million jobs, and 1.6 million businesses already in these Qualified Opportunity Zone funds. We think that we have the ability to outperform what traditional equity and fixed income markets will offer investors in the future, and at the same time have very low to no correlation to those respective markets. As I mentioned earlier, the reason we're comfortable doing this is because we've had a history doing it. And we found ourselves in what these newly designated opportunity zones are from past experiences in low-income housing, solar and renewable energy, and historic rehabilitation projects. Due to the fact that we've allocated over $1 billion to these various projects over the last 13, 14 years successfully, we're very comfortable continuing the programs as we have done them in the past. In the next page on the structure of our organization, what really allows us to be comfortable going forward the same way we acted in the past is because our acquisitions grew. is so good at identifying opportunities in historic, solar, and affordable housing that it gives us a tremendous pipeline in opportunity zones. On the next page, I've given you a snapshot of a few deals that we have approved. This comes out of a very large pipeline. And if you look at this pipeline, you would find that many of them come from the market rate housing area and the workforce housing area that are being developed by our internal and external development partners. What I'd like to do is to dig in very quickly into one of the projects so you understand what we're doing, why we're doing it, and how we got there. This is a project in Indianapolis that we're doing with a development partner that we have worked with previously, TWG. The project happens to be dead across the street from another one that the same developer has done. It was done a year ago. It was very successful. The demographics are identical. The benefits are a little different, being that we're in an opportunity zone and we're able to use qualified opportunity zone equity. It's roughly a $30 million deal. We're going to put in $4.5 million of OZ equity. We're offering the investors what you'll see on the next page, an after-tax IRR of 13.1%, which is a 2.1 multiple on the MOIC. You'll see on the benefit schedule that we put in $4.5 million and expect to get out $6.1 million as a gain. If you have any questions about this model or any of the statistics, please feel free to call us at any time. I'd like to close by just kind of recapping why we're going to continue to do what we've been doing in these areas. Because we've had a deep management team that has found a lot of success operating in what are newly designated opportunity zones. We've been there for over 13 years. We're not going to change the formula. We're just being given a benefit by the government that helps us from a tax standpoint. We're very conservative in our structure. We try to be as investor-friendly as possible, and we're blessed to have very attractive deal flow. And we would welcome your involvement. So please feel free to call us if you're interested. We have included the terms and conditions in this, as well as please feel free to contact me if you want a copy of the deck, the term sheet, or anything else that goes along with the recent guidance that we received from Treasury and our answers to what we consider to be frequently asked questions. Thank you very much.
Thank you, Billy, and thank you for joining in. Again, please contact Billy at BHUGER@monarchprivate.com or call him at 404-307-0075. Thank you for joining.